So a CNBC contributor. Let's start, Sarat, maybe with your first name, CVS. Why do you like it?
So this is a self-help story, Tyler. If you look at the stock, it trades at 10 times earnings. Its comps trade at 17. You've got two things going here. One is they're restructuring the stores up front, and the other one is the merger with Aetna. And I think the combination of the two will give them the operating leverage they need, the earnings growth that you're going to get that not many other companies are really going to have in a downturn. And at 10 times earnings and a 3% dividend yield, I think you've got a lot more upside here than downside in terms of cash flow and capturing the earnings resilience.
I think of them increasingly as a healthcare delivery and payments company that has a store attached to it. Am I wrong?
You are absolutely correct, and that's where they're kind of trying to do everything. They're trying to get people to go to the store and then kind of do the combination of delivery. And now, if you look, they're trying to make an acquisition to get more into the physician side. That is a little bit of an overhang, too, on the stock. But at 10 times earnings, you're getting paid to actually wait for them to do something, and then that could be accretive to earnings. So
how many times?
I do like that whole kind of...
Yeah, no, I'm sorry, Sarat, I was saying to Tyler how many times we heard people... Yeah. With CVS being a recent pick. Tell me about EIX, not as familiar, Edison.
So Edison trades at 14 times earnings. The average utility stock trades at 18. And what you've got here is earnings growth of about 5 to 7% on the distribution and transmission side. That is regulated. So that's pretty much what we would say in the bag, plus a 4% dividend yield. And in an environment today when you can get 5 to 7 earnings plus 4%, you're looking at high single digits to 11% on a return. And an overhang here is that, it's been almost 4 years since we've had those severe storms out in California. So people are still a little bit scared to invest. But once we get to the fifth year, you don't have the payments going forward, which are already built into earnings. So again, a stock that has resilient earnings in a volatile market where, where can you expect growth, especially when you see what's going on with the Fed and other companies kind of cutting back on earnings.